Another Q&A period from last week's or the most recent market outlook. I'm worried there will be a really bullish reaction of the first rate cut. Then if, and only if, the economy continues to show weakness, people will realize there's no reason to be buying. The markets will sell off since the Fed is not cutting rates because of a strong economy and slowing inflation, but because of economic weakness. I would argue that the data last week consistently showed economic weakness. Market didn't care. And I think that even with a rate cut, I think you'll get a rally. I don't think the market really cares at this point about the valuation. The only thing I think that can take this down is earnings that come in consistently below expectation, or guidance that is continually below expectation, or some external event that accelerates an economic downturn. But just on its own, I just don't see it. The tone of the conversation just doesn't seem to be anywhere near there. In many things going on in the U.S., that the conversation just seems to be ignoring some of the obvious things. The conversation around Biden and after the debate performance and even after the interview performance, that, just ignore it. Why are you fretting about this? And, you have all of the, circling the wagons around them in the Democratic Party. It's like, but you're ignoring the obvious here. And I don't think they really care. So I don't know. I really don't know if that's enough to take it down. I'm kind of in uncharted waters here. I've just never seen a market consistently not respond to cues, and a number of asset prices simply not respond to any semblance of fundamentals. It is a weird market. Things that shouldn't be undervalued are. Things that are overvalued shouldn't. We can clearly see the extent of undervaluation and overvaluation, and it just doesn't seem to matter. Buying out of the money calls in Tesla with 100% implied volatility rank based on no fundamentals is crazy. I agree. I'm in. And if you did that today, Tesla was up another $10 or $11 on nothing. On nothing today. There was nothing. Just why the hell not? If you're buying Tesla, you have to just ignore the value of what you're buying. It doesn't matter. It almost makes a mockery of investing. One analyst on Bloomberg, I don't think it was on Bloomberg, reported that he had said that this is a meme stock now. It's not even behaving like a stock. It's just a meme stock at this point. Can you explain how PMIs, ISMs work? As I understand it, they measure by month. So PMI at 48 is a little worse than last month. 50 is the same as last month. No. It is based. It's not based on the month before. It's just based on a series of questions, and the answers to those questions depend on whether or not there's expansion or contraction, and they add up the indicators. A reading of 50 is saying that the sector, whatever it is if it's for PMI, if it's for manufacturing, the ISM for manufacturing, is saying that there is neither expansion nor contraction in the industry. A reading of 48 says there is contraction. To say that 48 is a little worse than the month before, if the month before was 42 and you had 48, this is contraction, but not as bad. You're doing this kind of thing, right? It's starting to slow down, so you're getting to the bottom somewhere, that when you get to a reading of 50, you're still way down here, but they're seeing no further contraction or expansion. Then 51 starts to say, well, now we're doing this in terms of economic activity. So under 50, it's just general contraction. 50, nothing to see here. Over 50, expansion. Since we've been below 50 since end of 22, things must be pretty bad. Um, yeah, well, I think they are. In manufacturing, it's been like that for a while. I want to hear your thoughts on the overall framework you've developed in preparing and presenting research. How you were able to provide such a valuable product in the CFA prep industry. What kind of process are you utilizing? What kind of questions are you asking yourself when carrying out the work that goes into it? Not asking about the business model, I'm seeking to understand the mental frameworks, common denominators behind individuals that provide tremendous value in their given field or specialty. I understand this comes with a lot of growth over time, trial and error, grit. What are some practical things that that have worked for you? So in the teaching part of it, having been in I think the university system basically my whole adult life, on one side of the desk than the other. You teach in front of a class. After a while, you can intuitively anticipate where the questions are going to be based on the material that you're presenting. Because you were a learner before, and in being a learner, you can recognize where other learners may have a problem. Sort of like a guide bringing you to the mountaintop. The first time the guide went to the mountaintop was challenging. So a good guide would have climbed that mountain many times, that as the guide is bringing you up the mountain, will anticipate where you're going to have a problem. And that's all that was. So it's sometimes you're just good at something. I was always good at that. And then beyond that, it was, let's put it this way, the value that you get is tied up very tightly with how you feel about the product. So if I had charged $1,800, you would have expected the value delivered. In fact, maybe you were a little disappointed in certain areas, saying, well, you didn't deliver enough of this or enough of that. Because really I focused on just the teaching part. So your pricing strategy is important as well. No matter what price point you pick, it was always one strategy: deliver overwhelming value, period. Not extract overwhelming value. So if we think about Apple, they do deliver value, but they extract value such that you're not left with the statement of, I got more than what I paid for. You're left with a statement of, well, for what I paid for, I better have gotten that, right? The price sets the expectation. Not that I lowballed the content in any way. I just have a problem with extracting a lot of value. I prefer to extract whatever it cost me plus some margin. I'm not greedy. And then I have more pride in the value I deliver. So I focus very heavily on the value proposition. I think too many businesses today focus very heavily on the pricing proposition, less so on the value proposition. And if you can do that, you can win any fight. On the last slide, can you explain where next 12 months operating earnings and EPS were pulled from? If you go to LSEG, it's in the description box. Click on that, you'll get a PDF. I think it's page 8, which has the next 12 months. And then the SP Global spreadsheet in the description box. There's a download for that. I think it's rows. You go down to 1.8, 1.9, 1.10. There's 4 rows. You'll see operating earnings, and you'll see the quarters written for each operating earnings. The current quarter will be filled in. The next row beside it is as reported. That's forward-looking. And then there's a space, and then this column is last 4 quarters operating earnings as reported, and last 4 quarters next 12 EPS as reported. So I get them all there. So you have to do equals this row plus this row plus this row plus this row on the way up to get the next 4 quarters, and same here. I wish I could show you with a spreadsheet, just I don't happen to have a spreadsheet handy. Let me, hang on, let me check the trash. No, I don't have a spreadsheet handy. Can you please elaborate? How did you get Q3, Q4 basis points cut for Fed funds futures? So if you go to October, ZQ, Fed funds futures, let's say it's 94.8. And then you go to January of 2025, ZQ. October because September is over, January because December is over, and let's say it's 95.2. The difference between this is 40 basis points. So the market must be thinking that between the end of the third quarter and the end of the fourth quarter, there must be a cut of 40 basis points coming. What are your thoughts on European car makers? VW, Mercedes, BMW. I like BMW. They're trading at very low valuations. Almost all car companies are trading at very low valuations right now. Their brand power might not be as strong in EVs. Tariffs on Chinese EVs have been introduced, but might not be sufficient or might lead to retaliation. How do you see this competitive environment playing out? Well, I think the Chinese EVs will continue to gain market share. The price point on some of those is ridiculous. I think that's the bigger threat to the traditional automakers are the Chinese automakers, not Tesla. I think the Chinese automakers are a big, huge threat to Tesla as well, because the Chinese have shown themselves to be more nationalistic than thought. That in that country, even though Tesla still sells quite a few vehicles, they're shrinking while the others are gaining significantly, gaining a lot more significantly. How do I see it playing out? Well, it comes down to the consumer. You know, what the consumer wants. I guess the more expensive you make it for the consumer, the harder it is for them to switch. I don't know at this point. I do see it as a threat. Even if you even if you you've managed to keep it out of the EU. So let's say there's the US and there's the EU, and they managed to keep the Chinese imports out of those countries. You still have Mexico, you still have Latin America, you still have South America, you still have Africa, you still have all of these other places in the world that these places sell vehicles to. Well, if the Chinese vehicles start going into these markets, it's going to squeeze out these exports. So it's not as if they're going to escape that. It's going to, at the margin, steal revenues. We just don't know how much it's going to steal revenues, but yeah, it is. It is a threat. Whichever market lets them in, it is a threat. Why do you use 40 billion as the runoff rate when you calculate time to get ample reserves? Shouldn't it be 60 billion? Yeah, so the 25 and 35 are the right numbers. 25 on U.S. Treasury. 35 billion on mortgage-backed securities. The problem is, with interest rates so high, mortgage-backed securities have both principal payments plus prepayments plus interest. This is called runoff. And with interest rates very high, your prepayments are very, very low. So the Fed says that runoff here is really only at about 15 billion a month right now. It'll increase over time, but right now, given where rates are, the runoff on MBS is running about 15 billion a month. So currently, because treasuries are capped at 25, you got 15 from MBS, you got 40 billion. Once they start lowering rates and the prepayments start to increase, maybe you'll get 17 billion or 18 billion a month in runoff from principal and prepayments. It'll start to increase as interest rates come down, maybe. But right now, it's only 15. There was a statement in the minutes, median expected timing for the end of balance sheet runoff, April 2025. What does this mean? That means a whole bunch of people said it would end before April 25, and a bunch of people said it would end after April 25, and there's the median. So some people thinking it'll end before April 2025 because they're anticipating that there'll probably be some kind of liquidity problem the Fed will need to solve, and the easiest way to solve liquidity is to stop doing that. Stop taking liquidity out of the system. And then some people are probably saying, well, at the rate we're running off, you're looking at about 3 years, right? So that might bring it out to 2027. So they're April 2025. There you go. Or there might be some kind of modeling saying that interest rates are going to come down at this pace, and because of that, prepayments are going to go up at this pace. So maybe they're more willing to use 65 billion right now, the 60 billion right now instead of 40 billion. What are your thoughts on using options flow data as a screening tool or as a way to determine where big money is flowing into as a signal? For example, you mentioned Tesla call option buyers driving up stock due to delta hedging. Well, the market makers would have to delta hedge. Is there a screen or specific options flow data can be predictive of stock trade? You just have to look at the transactions. If you looked at the 3-day today, you looked at 3-day to expiration options. The at the money volume on options on just that one strike, never mind all the others, on just that one strike was 137,000 contracts. The next one up was 56,000 contracts, and big numbers like this. And you look at the puts, they're 30,000, 40,000, 25,000, but nowhere near the size of what the calls are. So I know that market makers on net are buyers of Tesla. And as long as there's excessive call option activity, more calls than puts, there will be from the market makers more buying than selling. Once the short side says, none of this, forget this shorting anymore, let's really just buy puts, right? Let's just buy puts, because then, if we lose, at least we know what we've lost. Once put selling gets above call selling, then market makers are net sellers of Tesla. So at this point, this stock has left the realm of any kind of value, tethered to any kind of value whatsoever, and it really is just a function of the call buying at this point. And so as long as you have a lot of calls being bought, market makers are net buyers. You can create a buyer by buying calls. Because if you buy the call, you have positive delta. The market maker has negative delta. The market maker has to buy shares of Tesla to be delta neutral. So if they buy calls, their book will get too negative delta heavy. They do have to buy a bunch of Tesla shares to get neutral again. And they have to keep buying. And it's the difference between how many calls they engage in and how many puts they engage in. It's the difference between the two. So every so often their system will tell them how much delta they're off, and maybe they have a system that automatically buys the underlying, I don't know, but they're more engaged in the buying and selling of these options. But the volume on the calls is so lopsided with the puts, they have no choice, probably during the day, that they're going to be negative delta throughout the day, which means they are buyers of the stock. And again, you're caught in this cycle where if people keep, or investors, I'll call it, and traders at this, call it gamblers at this point, keep buying calls, the market maker must keep buying stock. So there is no reason for you to short if everyone's buying calls, because the market maker has to buy. So shorting the stock, until that cycle breaks, you're going to get crushed. But, as I said earlier, it's in meme stock territory now, which means the fact that you can do that with the calls is enough to just keep doing it with the calls. It's now a game. It has nothing to do with what it makes, how profitable it'll be, what its future is. It has nothing to do with anything anymore. So, and then I'm sure there's the group of Tesla investors out there feeling that this is perfectly justified by the value of the company, because in 5 years we'll all be driving Teslas. They'll all be driving themselves. Some of them will be flying. we'll all have robots and everybody's car will drive around at night and make $30,000 a year. There are people who truly believe that, But then again, there are people who truly believe a guy named Jonah was swallowed by a whale at some point in history. So, I've been slowly getting into understanding financial statements by explaining each line item as you showed in ABR's video. Now I'm wondering how to take the next step, which is moving from just matching and understanding to actually evaluating whether those numbers are good indicators of company's potential. Any tips or advice on how to approach this effectively? Well, those are footprints. You're looking at the footprints and determining whether or not the person making those footprints had purpose or was simply just drunk. You need a story. You need some story about what the company is doing, because the numbers on their own mean nothing. If I give you 1/4 of numbers, they really do mean nothing. It's, well, where have they come from? So if I say this company has a cash flow yield of 11.5%, that is cash flow or free cash flow over the share price, 11.5%. Well, what does that mean? It means a lot if they've gone from 4.5% to 5.5 to 6.5 and moved up to 11.5. It doesn't mean a lot if they've gone from 20% to 18% to 12% down to 11.5. So the number 11.5 on its own is rather meaningless. There'll be a trend in the numbers that you want to look for. And then there's some story around the company. And you look for a good story. Sometimes you can find companies that have very low valuations, but fully justified why they have low valuations, because you head to bankruptcy through a low valuation neighborhood, right? That is why sometimes value is called a value trap, because what you think is value is not. Looking purely at the numbers will bring you to a value trap, but thinking about the story that's involved and management's version of the story, I think, is important. So you have to understand the statements. You have to understand the revenue, how they generate revenues, how much of the revenue they get to keep versus what gets paid out in expenses. From the income statement or the cash flow statement, how much of that revenue, how much of that net income is actually cash. You want to see more cash flow from operations than net income. And you want to see that consistent over time, and a good story, whether it's a growing economy, whether it is a tight market that the company is operating in, whether they have a superior product. Is that a defensible product that they have? Do they have a management team that is known for execution? ABR's management team has executed in some tough environments. So you look at all of those things. Can you please describe the rules you have for your Theta portfolio with examples? The rules I have is I don't sell puts on anything I don't want to own. And if I do sell puts on something I don't want to own, I know I'm gambling. I know I'm not doing what I believe in. When I stick to my rules, when I sell puts on things that I don't mind owning, I do okay. I do very well, and I have no rules. If I sell puts, I'm absolutely okay with the underlying being put to me. I'm okay with that. If I sell calls, it's usually because I have the underlying. It's risen so much in price, I feel like reducing my risk a little bit. I'll sell some calls. If the underlying pulls back, I get to make some extra money. But if you are running a Theta portfolio purely for the income, that's your motivation. You really don't want the underlying. You have a certain amount of capital and you want to generate a return on that capital through Theta, through selling. The typical rules are, at least that most professionals follow, is your options are going to be in the window of 30 to 45 days to expiration, and you're going to look to be closing them out somewhere around 15 days to expiration. 10 to 15 days to expiration. The further away the stock price is from the strike price, the more likely you are to let these continue on to expiration. but let's say that your strike price is $55 and the stock is 55.64. Let's say just a little above the 55. You got 15 days to expiration. Theta has made a lot of money for you. Gamma risk is going to start to increase. Usually at this point you'd start thinking about closing. Most professionals who do this professionally, this is what they do for a living, will take profit at 50%. So if you sold a put and you got 80 cents, they would look to cover at 40 cents and take profit. Now they're selling puts with about 20 delta, which means they have about an 80% probability of success. So 80% of the time they're taking profit. The other percentage of the time, if they're in a loss, if you sold it for 80, you would exit your trade at 160. You would take a 100% loss. So if you think about if everything was a buck, you made 8 times 50 cents, but you've lost $2, right? Because you've lost 2 that lost a buck. So that ends up being $2 that you make on your trade, basically. Just playing the probabilities you're going to make money if you follow your rules over a period of time. Now, it may be that all your trades work out, not just 8, but in a given month, all your trades work out. In another month, 6 don't work out. In another month, 7 work out, 3 don't. In another month, it's 9 and 1. It's over time. You would expect this 80-20 split over time. You improve your probabilities by having better underlyings, by selecting your underlyings very carefully and making sure that your underlyings are not all 60-70% implied volatility. The nice sweet spot I found in there is about 20 to 30% implied volatility, and augmented with a few that might be 15 to 20% implied volatility, because those are really slow movers. This is rather rational, and make sure you choose an underlying that makes sense, where imagine that it would be put to you, right? You don't want it to be, but you can imagine that it would be. Would you be okay if you had to hold that stock? Would there be a reason why you would say, oh, well, I'd buy it at that price anyways? Then that's an underlying, and that's how you do it. Once you start getting greedy and you start playing with those stocks that have 60-70% implied volatility, you'll learn very quickly why they have that kind of volatility. You're on a bucking bronco. Trying to make it to the 8-second bell doesn't sound like a lot. Well, 8 seconds, I can stay on that thing for 8 seconds. Good luck with that, right? Describe the rules you have for your Theta portfolio. Already did that. Because I read the same question twice. Okay. I had a Biden moment there. For someone totally new to this, what daily routine would you recommend reading newspapers? Newspapers? How old are you, dude? Newspapers. There's no such thing as newspapers. I don't think I've ever read a newspaper. Everything is online. But I get what you're saying. Markets are things to follow, to keep an eye on, regardless of whether you're in American markets. I don't really care too much for newspapers. I mean, if you're going to do it, stick with the big ones. Wall Street Journal, Barron's, I think are good. The Reuters news feed is not so much a reporter giving you a story as it is just a news feed. It gives you headlines, right? Wall Street Journal and Barron's, they go a little bit deeper. The best sources are industry associations. So if you are into automotive, into the auto industry, Cox Automotive has a newsletter that they'll send out to you, along with the presentation for their Manheim Used Car Index. Every month when they release a number, they'll send you the presentation an hour before their they do their live webinar. So you get to see the presentation. If you're into ocean shipping, Splash, I think it's Splash 24/7. Is a fairly good one. Gives you a bunch of headlines that you don't have to search for, neat little headlines, and you could just click on it and follow through, whichever one you want to read. So I would look for the industry associations and sign up for the newsletter. That's what I would do. And then it comes in your inbox, and whatever you're interested in, that's what you get. Do you still have July BWA 35 puts? They were put to me. Mine were assigned early, so I plan to wait for a run up around 34.35 before selling some upside calls. Yeah, I paid. I got $1.15 for selling the 35s. They were put to me, so my average cost is now $33.85. They did get an upgrade. Just I think a day, either today or yesterday, they got an upgrade. So that's a good thing. Yeah, I think I'd do the same thing as I would wait for a nice day, a nice rally on a particular day, and I'd sell something. I'd even contemplate selling the $30 puts on this as well. So I think for August, the 35 calls were paying 25 to 35 cents. Nothing that really excites me, but you get 35 cents, suddenly I'm looking at 33.50. Right, so you slowly work your price down, but BWA is not going away, so I don't feel the need to do that. There will be a rally at some point. There will be an opportunity, and I don't mind holding it. I have a question that might seem silly. Is there one applied level per CFA? Oh, I already answered that. Nope, there's only one applied level. You only have to buy it once. So level 1, you buy CFA plus. Then level 2 and level 3, you just buy regular CFA. You don't need to buy the plus. You already own it. In fact, I don't think our system will even allow you to buy the CFA plus if you already have the applied level, because it knows you already have it. Okay, we got an essay. I might actually have a personal theory on why markets keep hitting new all-time highs. Could it maybe be that people are waking up to the fact that slightly better inflation is preferred, given the reluctance of government to slow spending down? Okay, I wouldn't argue with that. And in the case where we are living with higher base inflation for some time, the best place to be is equities. If it's demand-driven inflation, that's true. If it's supply-driven, that's not necessarily true. Also explains the strong commodities. Well, strong commodities create inflation. It's not that, hey, we have inflation, people then buy commodities. That's where inflation starts, usually in commodities. Government and Fed will be there to backstop any potential slowdown or crisis. And it definitely seems we are living in financial repression. So I'm just making the devil's advocate here. Why not be in equities? I am. Above scenario seems to be a win-win for all. The only unfortunate case is hyperinflation taking root. I don't see that. Or major exogenous economy stopping shocks. There will be one of those. Those are always there. There will be one. Who knows when? Who knows what it will be? But is there going to be some exogenous shock that sends the global economy into a tailspin? Yep. There always are. There always are. But other than that, it's equities and commodities for the win. Yeah. So far, yeah. But you have to temper that with some kind of rationality to say that there is a limit to what you're going to pay for it, right? Because I can make the same argument for houses, and we got to live in a house. I mean, we've been doing that for decades now, for centuries now, living in houses. So housing prices have gone up in the past, and if there's going to be inflation, the cost of building a house increases, so the best place to be is in houses. But at some point, you're not going to pay $10 million for my house when it's worth $2 million. You're just not going to pay. You're going to at some point say, well, what am I getting for what I'm buying? What's the value of what I'm getting? But yeah, I think being in equities is the right thing. I think it has more to do with the level of passive money than active money. Passive money is value agnostic. It does not care about the value it buys. It only buys in proportion to what the index is holding, period. So when money goes into ETFs, there is a belief in a story without consideration of evaluation, because you're buying a diversified portfolio, who cares? Well, the largest holding in that portfolio goes up. The largest holdings tend to be S&P components, so the S&P keeps hitting all-time highs. you don't have enough active money to fight against the short side to bring valuations back into line. So I think it has more to do with just the sheer rise of passive investing and the sheer rise of dating applications for the market, where you're not really buying the stock, you're buying calls. When you buy options, you're really dating the stock. You're not investing in it, you're dating it, right? Just the sheer rise of that 0-day to expiration options, mostly from the retail investor. That is, again, also valuation agnostic. They don't really care too much about the value of what they're buying. They care about the process of how they're buying it. Call buying forces the market maker to buy, and that's pretty much the action going on there. And then passive money flowing into the market doesn't care about the valuation it's paying for. So bigger stocks simply just get bigger because the ETF buys in proportion. Well, they don't actually buy. The sponsor, the authorized participants buy in proportion and then trade them in for shares. So I think it has more to do with the way the structure of the market has evolved to include a significant level of retail investors that are more concerned about dating stocks and passive money that is valuation agnostic. You taught us how to manage loss elimination using call put options. Does this same process apply for futures? Yeah, you can do that. There are options on futures. You can do that with options on futures, but your underlying has so much leverage. The futures contract already has leverage. Once you start getting options involved, unless you really know what you're doing, two things: stay away from the options on futures, because you have to be careful about what the underlying is. The underlying may not be the futures contract you're in, even though there's options on that futures. It may be a different contract altogether with a different underlying price, and the options are centered around the price. So in equities, options are centered around the forward curve, which is upward sloping. So every month is centered around that. For futures, it's 3 months at a time, and it looks like this. So you can say, well, it's the same thing, but it's not. It's discontinuous. There is a certain date at which you'll have options where this is the underlying, and on the same date you'll have options where this is the underlying. If you don't know what you're doing, be very careful. Also, there's probably no reason for a retail investor why you need to be in a futures contract unless you really know what you're doing, right? I'd kind of get off the sugar high of leverage. That's nice on the way up, but at some point it will kill you. If not, what's the best way to manage a losing position on futures? Get out. Find an ETF that tracks the futures, and that's slower moving, and then use the options on the ETF. You'll have better luck. Or at least you'll be able to stomach the volatility better. That's because futures have added complexities, such as options being largely European style. It doesn't matter if they're European. It doesn't matter. It just means last day exercise. You kind of would like that, because you're not going to wake up in the middle of the night finding that something was put to you. If they have European options, nothing can be put to you until the very last day. That's all that matters. Options being largely European, and they have all options have contract expiration dates, and all futures have contract expiration dates. You have to roll your futures contract every month. And if you're not sure how to do that, depending on the curve being in contango or backwardation, and depending on if you're long or short, could continually cost you money in the negative carry to roll your contract. Now, if everything I'm saying to you and you're thinking, well, what is that? Stay the hell away. Right? Stay the hell away. If you're not understanding what I'm saying, that's a clear sign that you're playing in a game in which you don't know the rules. So you may get lucky and make some money on it because all you're doing is betting on a price movement, but there's a whole bunch of issues you need to know with futures and options on futures. So wondering what sector is the most boring one in the economy. Utilities most likely is the most boring one in the economy. I want to invest in some boring companies with solid cash flows, good dividends before. It's utilities. That's utilities. Regarding the risk reversal on XLU, the calls are quite more expensive than the calls. So you got to go one or two strikes out of the money to make it cashless. Yeah, that's true. Because that is because of the high interest rate. The higher the interest rate, the steeper the forward curve, and options will be centered around the forward curve, not the current price. So here's your stock, and 1 month out, 2 months, 3 months, 4 months, 5 months, 6 months, 7 months. If you're looking for the 50 delta, they will be on the forward curve, and the forward curve is a function of the risk-free rate. The higher the risk-free rate, the steeper the curve will be. In terms of where the 50 delta call is centered. So yes, to make it cashless, you do have to go out of the money. But don't pay attention to the strike you get, pay attention to the break even. Doing an at the money, when I looked at XLU, doing an at the money gave me a break even of like 69.40 something. Going to the 69s because it was 68 brought the break even down. Going to the 70s brought the break even down even more. Going higher brought the break even up. So my lowest break even, 69, I think it's 69.08, I think is my break even, gave me the lowest break even. Now that's break even at expiration. That's not break even today. That's break even at expiration, 69.08. So I used the 70s. Playing Tesla Momentum, would this be a good scenario for a call ratio back spread? It would be a good scenario for just buying a call. Plain and simple. Make it simple. Don't get fancy. Make it simple. Unless you want to own the underlying, I wouldn't even bother with the put, selling the put. I would just buy the call. Period. Will you be doing a video on your analysis of Jackson Hole Economic Policy Symposium outcome? As it comes out, I'm sure I'll include it in my market outlook, yeah. Sector Spider and SP Global are wrong. Looks like LSEG is the winner. Well, there you go. The fact that we have to fact check them on something so simple is a problem. Right? I mean, that's a big problem. I mean, if my plumber came over and said, okay, I need a Phillips screwdriver, and reached and said, aha, here it is, and had a Robertson in his hand, I'd say, whoa, my friend. I mean, if you don't know the difference between the screwdrivers, I got to question what else you don't know. I mean, if you can't get this done, this is the difference between a Phillips screwdriver and a Robertson. If you can't figure out the two and you call yourself a plumber, I don't want you unscrewing anything. I don't want you doing a damn thing. This is sort of how I feel about these data companies here. Is like, if you guys can't get this right, well, why am I supposed to believe the other stuff that's harder? A while ago, I sold June 28, 42 put on Newmont with a premium of approximately 145. I don't recall the exact amount. It was close to that. Newmont options were exercised at 3 a.m. on June 29th. Now my average price is 40.64. You had 42, which means you had premium of 136. You say 145, you don't recall the exact amount, I'll tell you what it was. If I received the premium when I sold the put, you did, and the strike price of the option was 42, it was. How is my average price 40.64? What am I missing? It means you got 136. If you really do believe you sold it for 145, what your average price does include is transaction costs. So if you're on Interactive Brokers, for example, and you sell a put for 80 cents, that means you get $80. Your average price might show something like 79.6 because it said, well, it cost money to get the option, so your average price is now this. If you had bought. If you had sold, it would be a little bit higher, right? Because you got to cover off the transaction cost. Perhaps you have a broker that charges you for assignment as if you had bought it. Maybe you have one of those brokers that charges $9.95 per contract. There's a $9 difference between 136 and 145. Maybe that's it. How and the options exercised at 3 a.m. if the market was closed? No, they're not exercised at 3 a.m. They are assigned in the middle of the night. They're exercised in the evening. The long side has till 8 p.m. 8 p.m. every night to give their intention to the clearinghouse that they wish to assign the underlying, that they wish to put the underlying to. They have the 8 p.m. that night. So market closes at 4 p.m. Bad news comes out. Bad news. And they can say, okay, well, I'll put the stock. They have all the way to 8 p.m. So they do have, the long side does have the benefit, this time option in here. They do have the benefit of seeing what happens after the market closes. They can assign it to you all the way up to 8 p.m. at night. Once they assign it to you, usually the clearinghouse sends you a notification of assignment, and sometime during the night it's actually assigned to you. Going through applied series quite slowly, wondering if you would teach the setup for acquiring data to Excel automatically using Python programs directly from site. No, that's way outside the scope of applied level. That's computer science at this point. I don't do that. I would strongly recommend YouTube for that. Lots of for that, you want somebody who is into computer coding. That's not me. So no. Want to practice delta hedging on IBKR paper trading, and I think Tesla is a good stock to practice on. Whew. Do you know any other names to practice delta hedging? Well, if you want practice, that will give you practice every day. Doing it on something like AT&T moves so little every day that you, at the end of each day, you'd say, there's no need to do anything. But with Tesla, yeah, you're going to have to hedge every single freaking day. And if you really want to get practice delta hedging, what you want is very high gamma, which means you want options like 7-day to 10-day options. That's all you're looking for. Even 3-day options, 3 days, 5 days, 7 days, those are the options you're looking for, because gamma is the speed at which delta changes. The faster delta changes, the more you need to delta hedge. So give that a try. Have you managed to pick up any of the puts in Canadian banks you were targeting? I didn't like any of them yet. Looking at TD, the Canadian dollar value TD 70 puts I'm looking at, but on Monday's market outlook or Sunday's market outlook, I said I want to see earnings first. I want to see what the loan loss provisions. Actually, I think that was on the Q&A, the live stream. I said I want to see what the loan loss provisions are first in Canada before I start selling puts. And we're so close to earnings. Why not wait for earnings to happen? I totally get your thoughts on switching targets for Tesla from fundamentals to their investor base. But is this a first base type trade? Is it now personal? It is not personal. It's not personal, okay? It's not. No, it's not personal. No, not at all. No, it's just a recognition that when you see something move up that much, that consistently, at some point you have to say, look, I must be missing something. I'm looking at this from a value perspective, and there's no value here. There was no value to justify 65 times forward earnings. Now we're at current earnings over 100 times forward earnings, unless you're going to be really generous with the earnings and say, oh no, they're going to be $20, so it's only trading at 12 times earnings. Unless you're going to be really generous on that. So at some point you have to say, look, clearly value doesn't matter here. It must be something else. So you think about the story, robo-taxis, this and that, and almost everybody agrees that the presentation you're going to see on August 8th will be just a dream. It will be like you have a young venture team in front of you, and you're a venture capitalist, and they have this crazy idea that will take years to put into play, and they want you to invest early in the process. It's going to be some moonshot that they have, and almost to an analyst that I'm seeing, not financial analysts, not the ones that are pumping the price of Tesla, but the ones that are in the industry, describing Tesla's self-driving as light years in the distance, light years in the future. So it can't be that. It's not the story. The story's too thin. So it has to be something else. if the fundamentals aren't working, you can't keep playing a game nobody else is playing. They're not playing the fundamental game at this point. To suggest that a shrinking company has a valuation, even though it's what, 1/5 the size of the largest car company, is worth 6 times more than the largest car company. GM is more profitable per car than Tesla. GM's growth rate in their EVs is much higher than Tesla. It's almost Tesla-like in the early years. Their cash flow is so much larger. You're talking about 13 to 14 billion in cash flow versus 3 billion in cash flow. GM's trading at 5.5 times forward earnings. Tesla's trading at over 100 times forward earnings. If it was about value, GM would be not a $56 billion company, but a $400 or $500 billion company. If it was about value, GM would be trading at a much higher multiple. But of all the car companies, it's trading at the lowest multiple, yet it's one of the most profitable car companies per vehicle that it sells. You know, go figure that one out. And it's buying back shares aggressively. So if this was about valuation, GM would be worth 10 times more than it is right now. Hands down, tomorrow it would be up 10 times its price, but it's not. It's not. When you have a $1 trillion car company, it's not an AI company, it's not a robotaxi company, it's not a robotics company. At this point in time, it is a car company. When you have a car company with shrinking margins and shrinking market share going up billions of dollars in valuation every single day, it's not about the value of the company any longer. So you do have to recognize that, look, there's a trade here, but it's certainly not the trade that a serious investor would do. So how would you play it? Well, you get on board and then you start preaching that this thing is, we've never seen a CEO like this before. Tesla's miles ahead of any other competition. They're an AI company. They're a robotics company. Everything but a car company. Musk is playing with shareholders. If there's news that looks bearish, it's only because Musk is playing three-dimensional chess, and it's actually, but you gotta preach that. You gotta say that that's what's going on, because the only way this is going up is if they continue to buy it, they being the ones that don't care about the value of what they're buying. Well, you can play that. Much like I can sell religious artifacts to religious people, even though I'm an atheist, I don't have to believe in it. I just have to believe that they believe in it, right? Which honestly does make a mockery of the whole investment landscape. When you start saying, okay, well, this is the strategy now, is to figure out what the crazies are going to do. Testing some directional strategies with synthetics. I want to get your thoughts on financing the call. My time horizon is 3 months. I buy it with 6 months to expiration, take advantage of convexity. By selling 1 month puts and rolling the position 3 times to finance the call, take advantage of theta decay. Sure, that is a good way to do it. I agree. I think that's a good way. That is just, you're buying the call and then you're selling puts to get the call for free. Yeah, but when you say finance the call, it's not really financing the call, is it? You're financing the call and then you're just working the price off. When we say financing the call, it means that the thing cost you nothing when you originally bought it. You sold puts to finance that call. I'm deluged with institutional research every day from several firms as my wealth management firm pays for many of these services. I used to get a whole bunch of that stuff years ago from JP Morgan, Morgan Stanley, Goldman Sachs. Every morning in my inbox, I'd have like 400 pages of stuff to read, and you simply just can't do it. It got to the point that I just would delete it even without opening it. I just delete it after a while because I think I don't even have time for this. And this isn't a one-page synopsis or a half a page synopsis of the highlights. These are 30, 40-page things with charts and detailed explanations. I don't have time for these deep dives. So I know what you mean. Sheer amount of information wears on me and puts me off looking at it. Same here. I finally just said, look, I don't want this anymore. I just unsubscribed. I said, don't send it to me. You're just cluttering my inbox. Mostly passive in my investing, but I have level 1. I can make sense of a 10Q, 10K. It's just that the applied series is currently amounting to infotainment. Infotainment? I don't know that I'm entertaining in it. Do you have any idea how, if you could describe what you mean by that a little bit more, send me an email saying, am I missing the point on something? Do you have any idea how I could get over this hurdle? Yeah, just ignore it. Finance is all I think about, just not company analysis at the moment, though it's kind of a North Star I'm trying to get to. The same thing with me. Even now, I have access to a whole bunch of stuff from J.P. Morgan. I don't really care too much about it. I don't know that getting my information secondhand is going to help me, because I'm not getting gospel. I'm not getting it from the source. I'm getting it from someone who got it from a source. For the most part, if you subscribe at companies that you're interested in, every time they have a news feed or an investor presentation, or they update something on SEC, you'll get a notice. And you don't get notices every day. And then whatever industries you're interested in, those are interesting because you can read the email very quickly because it has the story headlines, and then you can click on one if you want to, right? But yeah, the institutional research, it is absolutely overwhelming. To the point where if you attempted to read it all, you couldn't do it. You'd be paralysis by analysis. You'd never get anything else done. Any insight you can offer on companies like NERP? Never heard of that. Sell you an algorithmic Forex trading bot supposedly has incredible returns. Well, does it? If they are full of it, I'd like to understand how. I don't know. I don't know anything about NERP. Currencies are notoriously difficult because they are a random walk. I don't think that there is anything there, and I don't think that any algorithm can do anything more than play probabilities or odds, which you could probably do on your own. I think more retail investors get destroyed in Forex than anywhere else because there's so much to understand about positions that you're taking. It's not a matter of just buying and selling. Whenever you buy a currency, you're short another currency, and you're paying interest on that currency. And you're paying interest on that currency, usually to the broker. And you're paying interest on that currency more than what the broker is paying. So the broker's looking for the margin on that. Meanwhile, the broker does not pay you any interest on your long position. So the broker is very interested in getting you to take positions, because the broker, every account will be long and short. So let's say CAD US, you're long Canadian, you're short USD. The broker will pay you nothing over here, but will charge you 6.5% over here, and the broker's probably getting that for 5.4%, and is making the spread 1.1%. So the more people I can get doing this, the larger the negative US balance I get, the more I make 110 basis points on that. That's all I care about. I just need to get you trading this shit. How do I get you trading this shit? You know nothing about this stuff. Hey, I got an idea. You see where I'm going with that? In the end, the broker makes money by the size of this cash balance. So, yeah. They're going to charge you interest on this, and then they're going to take the CAD money and they're going to get maybe 4% on whatever the overnight rate is on the CAD money, because it's real money sitting in the account. Once you do a trade, you do have real balances. You have a long cash balance and a short cash balance. When you're trading Forex, this is not a security. You're actually trading the cash. You're trading the actual currency. If you have the applied level under portfolio construction, we did this with the Japanese yen. We wanted US dollars, but we didn't want to pay a big interest rate on it. So we went ahead and shorted 1 million US dollars in Japanese yen and paid the Japanese interest rate, which was almost nothing, took the US dollars and invested in a money market security that paid 5.5% or 5%. We couldn't actually buy T-bills in the paper account, so we bought an ETF. And that's how we become the broker, right? Is we make the spread on the cash, but we have currency risk. Well, how do you get the spread without currency risk? Well, what you do is you get some other noob to take the currency risk. So you come along, you say, hey, I like this idea, and you go ahead and start trading. You have all the currency risk, they have all the interest rate spread. Do you get that? You're being used. Almost anything out there that you think, hey, this is clever, I'm going to do this. Almost anything you can do on your own. So constant portfolio protection insurance, CPPI. These are structured products like guaranteed notes. You give me $1,000 and I will give you the return on the index. If the return on the index is low, I'll give you your $1,000 back. And you're not going to get the full return on the index. You'll get the return on the index, a certain percentage of the return on the index, and then it's capped at some level. What the bank is doing is it's saying, okay, well, that's a 5-year note that we've sold you. Great. What we're going to do is we're going to invest $960 of it, and we'll take $40. They'll invest $960 because it'll grow to $1,000, and they'll get the money market rate on $960. It'll grow to $1,000. They'll buy $40 worth of call options. If the call hits, then you'll get paid off. If the calls don't hit, they'll give you this much. That's all there. You could do it yourself. Right? MicroStrategy, you think you have leverage in Bitcoin, you don't have leverage in Bitcoin. And even if you did have leverage, even if they did have leverage, you can get leverage yourself. You don't need them. You can get even more leverage. If they say, well, we have 20% leverage, well, I can get 30% leverage, and I don't need to pay double for each Bitcoin to get it. I can pay the price of Bitcoin and create my own, almost everything you can create yourself. But if I wanted to do a carry trade, I want the interest rate differential between two currencies, but I don't want currency risk. Well, I'll get you to hold all the currency risk, and you might make money. You might make money, but I'm guaranteed to make money with no risk. I am guaranteed to make money. Do you get that? You're the trade. You're the trade. You're the source of their free money. That's all. Past first level. Now, let me spend a little bit of time on that statement that this thing I just gave you. There are in the finance industry, there are probably more sleazy people than in, I was going to say the law profession, but in sheer numbers, yeah. In sheer numbers, there are more sleazy people in finance than there are in the law industry. As a proportion of the players, though, the law industry wins hands down. But you will never bump into more slimier people than you will in the finance industry. I mean slimy people. Why? Because that's where the money is. That's where everybody has money. So if I can sell you a dream, you'll buy. And that's why you have these charlatans. Search my website for a video called the Coin Toss Con. I'll spell it out for you, Coin Toss. Right? Any of these sites that say, hey, I've got ideas for you. I give you 10 trading ideas a week. 10 trading ideas a week. That's con. They're selling you coin tosses because in a bull market, 8 to 9 out of 10 stocks go up. So all I have to do is just grab 10 tickers at random every week and give them to you, sell it to you, and you think you're doing something great. It's the Coin Toss Con. Things like this, like what the system, there is no system for Forex trading. And if they're telling you incredible returns, well, that is way outside of what any professional would tell you. You can't say that kind of stuff. You can talk about history, but it better be audited history, and it better conform to some reporting standard. Chances are it's not. It is designed just for their benefit. Be very careful. Finance is full of a lot of scumbags. A lot of scumbags. Next one. Passed first level of CFA and just became market analyst in a consulting firm in Italy, focused on commodities like gas and energy. Like to create a market outlook like yours, but for the instruments we use to analyze. Clients are mostly from Italy. Do you have any advice? Well, then you're going to be looking very heavily at inventories and production. The IEA produces a whole bunch of information on that. You're also going to be looking at where the location of production fields are versus the location of refineries, and which refineries have outages. You'll also be looking at because extracted oil fields are in one place, refineries are in another place, and then markets for finished products are in yet another place. Sanctions matter, and choke points matter. Right now, oil tankers have to take longer routes, so tanker rates are higher, which is why oil prices are higher. So if you're doing it for commodities like gas and energy power, you're very focused on that whole ecosystem of where is it extracted? How does it get to where it's going? Does it have to travel longer routes or shorter routes? Where are freight rates? Where are tanker freight rates? Because if tanker freight rates are going up, the price of what they're carrying has to go up. So there's a whole, that's a big whole field, but that's the place you chose to play in. Index strategy. Do you have any advice like drivers, index strategy, or YouTube channel that maybe are analyzing the subject? What's that bird? It's a cartoon. Doomberg. Doomberg is a big energy analyst. So you can look for Doomberg, but you won't actually see the person. He hides behind I think it's a green chicken. And the IEA, the International Energy Association, produces a whole bunch of data. You're going to want to get involved in that, and you're going to want to keep your eye on the tanker market, especially the categories of VLCC and ULCC, ultra large crude carriers, very large crude carriers, and what their rates are, what the rates happen to be. And of course oncoming supply. That'll tell you how much like you could have the price of oil. You could have a market that's in equilibrium in the oil market, but shipping rates going straight up, and the price of the oil may be constant, but the price of the finished products that the refinery puts out will go up. So you can have oil flatlining and the price of gasoline increasing, even though this is a fully supplied market, simply because shipping rates are skyrocketing, right? So yeah, you got a big task ahead of you, but every day you'll figure something out. In our analysis, we monitor storage level. You have to. LNG production, yeah. TTF spot and futures, nuclear power energy, renewables, gas demand, supply in Europe and Asia, political situation, yeah, okay. CO2 for weather. I'd like to add something more. No, I think you're in there. Energy is very seasonal, especially in the second half of the year, because more finished products have to travel to more northern climates because of the winter. So you will have seasonality in pricing, and economic development is big. The more a country, like GDP costs money. I shouldn't say costs money, sorry. GDP is energy intensive. If you expect a particular country to really have very high, like increased GDP, every dollar of GDP requires energy. China is very energy intensive in its GDP. The US is very energy efficient in its GDP. India would probably be very inefficient in its GDP. So if you see a lot of foreign investment going into India, then you can count on a lot more shipping going to India. And if you have a shortage of shipping, up go the shipping rates, right? So countries that are developing tend to be extremely inefficient in terms of the energy cost per dollar of GDP. So if you are projecting greater demand going forward, it's going to be from these developing markets. I guess that's about the most helpful that I can be on that. We'll be subscribing to Applied Series. Allow us to claim refugee status at your place in Costa Rica. It doesn't allow you, but it certainly gets you to the front of the line on an argument of why I should let you pass the gate. Oh, okay, you're a client. Oh, okay, well, give me a minute. Curious to know your thoughts on institutional strategists that are in the news and how much weight you could put on their predictions. Everyone's got a prediction, right? Kalanovic of JP Morgan recently stepped down due to missing his bearish prediction. It seems like Wilson at Morgan Stanley could follow suit. Thoughts on the possibility of big bank strategists intentionally producing unalarming outlooks just so they don't become a headline loser job? Well, that's been going on for how many years, right? Is you want to be in the middle of the crowd. You're never going to lose your job for saying what everyone else said. It's just if you go out on a limb and you're wrong, well, that's the problem, right? So you do get a herding mentality. If you have strategists that are raising their price target on S&P, everyone will raise their price target on S&P because you don't want to be left out. That's this is the unfortunate thing about a system is you have to start thinking game theoretically. Is that I can tell the truth, I can tell you what I really feel, but is it in my best interest to tell you how I really feel? Maybe it is. Maybe I'm in a place where I'm free to tell you what I actually think, or maybe I'm in a place where it's risky to be very different than the crowd. So maybe I have to run over and be part of the crowd just so that I protect myself. You have to start thinking that way. So a lot of times it's better just to be an independent, right? No one, who's the Canadian guy who's just a perma bear? His name slips my mind right now, but he's, no one can fire him. He has his own firm, right? Not sure how much knowledge you have in the insurance industry, but with the increasing rate in natural disasters, cat losses, just for people who are thinking cat losses, catastrophe. If you sell, they're called cat bonds, CAT, catastrophe bonds. That's what that shortcut means, cat losses. It's not actual cats. What is your outlook on the smaller premium insurers who can't handle a large loss? Most of them reinsure. So if you look at insurance companies, you'll see that there's a certain amount for reinsurance, kind of like the wholesale market for insurance. So it's almost like a carry trade. Is I'll sell you insurance for $800 and I'll reinsure you for $600, and I make $200 no matter what, right? So they'll look to reinsure. Can't handle skyrocketing costs of reinsurance. Oh well, okay. So you're aware of reinsurance. Will they ultimately get bought out by the larger players? Well, depending on their book. I mean, if you're a low-cost insurance provider and you're a bigger player, or I'm a bigger player and I'm looking at you and I'm saying, well, listen, if I buy you out, I can't keep these rates. I got to raise these rates. And if I raise these rates, I'll probably lose the very customers you have. So I'd be interested in buying you out, but you must raise your rates first and let's see what happens to your customer base. If you can keep your customer base, here's the multiple I'll pay you, or here's the value I'll give you. But there's always the risk that if you raise rates, you'll lose those people. But I don't know enough about insurance to know how that stuff works. For valuing companies' skills, I want to be professional about it. Also for complex cases, how can I get started? What is your recommendation? You get started by starting by you simply just start. I mean, how do you get started in? I want to know all about biology. Well, you grab a textbook. You start. You start. Grab a company's 10K and start reading it till you say, I don't understand this word. Google it and understand what that thing means. If there is a term you don't understand, Google that. And it won't take long before you get to industry associations that have an education center. Well, then you'll educate yourself there as much as you can, and then you'll start reading more and you'll start understanding more. And you'll find some analysts out there, that have a Substack that you can subscribe to that have their research. You can start reading their stuff, and you simply just start. In the beginning, it will be massively overwhelming, and you'll think, oh my God, there's so much. I'll never get this. There's just so much. Does anybody have a step-by-step guide? Because you're going to want it step-by-step. That doesn't exist because the knowledge exists in a complex web, not in a linear procession, but in a complex web, where I can tell you about this, but before I tell you about this, I got to tell you about this other thing. But before I tell you about this other thing, I got to tell you about this other thing that's connected to the first thing that I got to tell you. So I got to tell you the first thing before I tell you the thing that supports the first. You see what I mean? It's all in this complex web of things, so you got to start somewhere. And in the beginning, your understanding will be, okay, I don't quite get this, I don't quite get that. It'll be frustrating. 2 weeks in, you're going to say, I'm not getting any of it. Then you'll read something where you'll say, okay, I get that part now. I get that. And then everything after that, you keep putting in the time, it'll all start clicking into place and you'll get it. But you start by simply just starting anywhere. It's not like you're looking for the stairs to walk down into the pool. It doesn't have any stairs. It's a round pool. You pretty much got to just jump in somewhere. It doesn't really matter where you jump into the pool. You just got to jump in. Just to play devil's advocate, couldn't ARK simply be rebalancing their portfolio since Tesla's sharp price increase caused it to be overconcentrated? I don't know that ARK ever cared about that. Probably more rules-based than a change of conviction. Well, I did say that. I said they sold 76,000 shares. They still got a large position, but they are sellers. We'll find out later this week when we see more of the SEC filings if they're selling more. Last time she put a crazy price target on Tesla and started selling at about $250. If you really believe these crazy price targets, listen, I sold calls on CapREIT today, $47 calls on CapREIT. CapREIT's got a book value of about $55. They're at $46.30 when I sold the 47s for 80 cents, only because I bought too many, right? I bought too many shares. So you could say, well, isn't that the same thing Kathy Wood is doing? Here's the difference. I think it can move towards its book value per share of 55, and especially if Bank of Canada continues its rate cuts, I think there is probably the target I'd be looking at. And I bought too many, so I don't mind lightening up. However, if I believe that its true price is not $55 but $550, and it's at $46.30, and I truly believed in 5 years it would be here, I would not be selling $47 calls. I would not be rebalancing. I'd probably be loading up if I truly believed it. I've said many times, this Canadian apartment REITs is my number one conviction trade, utilities number 2, copper number 3, but this is my highest conviction trade. I have way more than a size that I should have, considering how much I have of this. 64,000 shares along with 600 puts. I have way more than I really should. But I believe it's going to 55 from, I was buying it at 43, I think 55. But if I really thought it was 550, no freaking way am I selling any kind of calls at $47. In fact, if I really truly believe that, I would say, why wouldn't I just buy more? This is a once-in-a-lifetime opportunity. If it's $46 and it's really a $550 stock in 5 years, what the hell am I doing? I just want you to think about what the compounded return is if you're buying something that you think, because they gave it an $8 trillion market cap, $2,600 price when it was $180. That's more than 10 times. But if we say that 5 years to get to that point, you're talking from 180 to that point when they released it, 17% compounded return per year. And that's assuming that you're buying the stock and not adding any calls to it. Why would you lighten up when you're at 10% of your target price? Right? Typically you lighten up when you start to get to 80, 85, 90% towards your target price. You start to say, okay, well, a neutral position is much smaller. A bullish position is much bigger. It's just not a good look when you are telling everyone it's $2,600, get on board, and you decide to sell 76,000 shares. It's just not a good look. Any reason CapREIT is trading at 0.18 price to book in premium to its industry peers? Yeah, I mentioned this before. The discount to net asset value. is that InterRent and Minto have much deeper discounts than Killam and CapREIT, is because Minto and InterRent have Ontario exposure, which has rent control at 2.5%. Killam is East Coast. They're in the clear. CapREIT is diversified across a bunch of provinces, so it's only Ontario, and it's only apartment buildings that are older than 2018 in which they have rent control. Same with Minto and InterRent, older than 2018. But they have exposure to other provinces that don't have rent control. So they would trade closer to their book value per share than Minto and InterRent would, because they have all their exposure to a province with rent control. So they'd trade at a deeper discount. So I don't know that I would say how come CapREIT and Killam are trading at premiums to their peers. I would say how come Minto and InterRent are trading at discounts to their peers, because this makes it seem like these are overvalued relative to these guys, but it's not. These guys are undervalued, but there is a reason. It's because of this exposure. Now you can look at Minto and InterRent, and you could look at their buildings and look at the years that they were built. Anything built after November 15th, 2018 does not have rent control. They're good on. Anything that they own which is older than 2018 or previous to 2018 has rent control. What proportion of their buildings are rent controlled? I don't know the answer to that. But as of today, what went up today? CapREIT and Killam both went up. InterRent and Minto both went down. May I confirm if the 2025 L3 full access package is 1 feet pass? Oh, that I don't know. I don't know where Serify is on their strategy for that. I'm going to get the applied level bundle. Your website already figured out by itself that my account is verified. That is nice. Could I ask how much time do I have to go through the bundle? No expiration. Take my time, go through it slowly over a 1 year period. You can go slowly over a 10-year period. Doesn't matter to me. How about Golden Ocean Group? Haven't seen it. DHI earnings coming up. Would you look at selling puts? Not ahead of earnings. Only after I have confirmation that things are good would I think about puts. I don't sell puts to gamble. Earnings are a gamble. So being that we've had elevated mortgage rates for quite some time and the data coming out of the housing market has not looked that good, I'd be hesitant to be selling puts. 30-year, 10-year, 30-year auction will add some risk for bonds. Yeah. Is that a cardboard box? I'm not quite sure what that is. Tesla is a trade for me, not an investment. It's a trade for almost everyone. I agree. For XLU, you sold puts. Synthetic means you are creating a stock without owning the stock, which means you're using options to get yourself a delta of 1 because the stock has a delta of 1. If you take a put and a call and they're at the same strike price and you sell the put and you buy the call because the put has negative delta, negative delta is a positive delta, and the call has positive delta and you're long, combination of these two should be very close to 1. Usually it's a little bit over, like 1.01, 1.02. As long as it's the same strike price. It doesn't matter. I could have used the $100 strike price, I would have had a synthetic. I could have used the $20 strike price, I would have had a synthetic. I chose the 70. That's the only difference, is how much I get paid versus how much I'm paying, but my delta should pretty much be the same. So you are now not afraid anymore about extended discussion about U.S. fiscal debt and bankruptcy. I don't know that I was afraid of it. You got back to selling puts on TLT. Selling puts on TLT has always worked. Don't know that I would be fearful of it at this point. The concern, I don't have concern about the debt. My discussion around the level of debt and the inability of elected officials to do anything about it, or the unwillingness to even do anything about it, will force the Fed to the zero line. That's what I said. It will force the Fed to the zero line. Bonds are priced mathematically, which means duration wins. I wasn't concerned about not buying bonds because of it. It's that the Fed will have no choice if this continues on. The end game before any crisis is the zero line, and hold the zero line for as long as they can. And at the zero line, if the market then decides, no, the 10-year yield should be higher, the 30-year yield should be higher, and you have a very steep slope curve, quantitative easing for as far as the eye can see, expand the balance sheet, buy the 10-year, buy the 30-year, flatten that curve. That's the end game with a mountain of debt. You have to manage the debt if you're going to manage the economy. Because if the Bank of Japan stopped managing the debt, the cost of new debt would crush Japan very quickly, and there'd be a default. That country would be done, given almost 300% of GDP is the debt. If you let it go, if you stop managing the debt, or at least if you stop managing the cost of the debt, everything over there falls apart really fast. The Fed will have a third mandate. It'll be unwritten, it'll be unspoken, but it will be manage the cost of the debt. That was my conversation around U.S. Debt and deficits. I don't think I ever said the U.S. is going bankrupt. As per your philosophy on life, do you consider an Olympic gold medalist a successful person? Well, sure. Why wouldn't they be successful? Successful just means that you've reached, you're in the top 10 or the top 1% of your field, right? And you can have success in many things. But a U.S. gold medalist is successful in their endeavor. I don't know why I would say that success only matters with money. Success matters with any accomplishment where you reach the pinnacle of all those that you compete with. Capitalism is one big competition, so yeah, I would think that person is successful. I get that the Tesla is overvalued with its current offering sales. However, this is what's making you biased against it, which is justified. Why would you kids throw this word biased around so much without understanding what the word means? When somebody disagrees with you, they're not biased. They may have a very good reason for disagreeing or having a different opinion than you. That doesn't mean they're biased. If your opinion is informed by facts, you're not biased, you're informed. Now, a bias would be, I owned a Tesla once. It was the worst car I ever had. It was a piece of crap, and the company sucks. Now I'm biased. That's a bias, right? But this throwing around the word bias, when somebody has a different opinion than you, maybe you're the one that's biased, right? And you're accusing others with informed opinion of being biased. But this easy use of the word bias, I really would encourage you to look up the word, look up the definition of the word, and understand that an informed opinion is not a bias. It may not be your opinion. You may have a different opinion. That doesn't mean the other person is biased. I don't know how many times I've been accused of being biased on this. I'm not biased. I'm informed. My personal opinion, Musk is a very unique CEO. See, now you're biased. I'll accuse you of being biased, right? Just because people don't agree with you doesn't make them biased. Maybe if everyone around you is biased, you know where I'm going with that? Musk is a very unique CEO of our modern day. Yes. This is what you have to. This is the story you have to tell now. If to play Tesla, this is what you have to do. You have to buy the stock, and then you have to tell people these things. Musk is a very unique CEO. He'll do what nobody else can do. I wouldn't bet against him. He says this thing is worth $30 trillion. I wouldn't doubt him. He says there's flying cars in 2025. I would believe him. He said full self-driving in 2019. I'm absolutely certain that is a reality. He's just not telling the market right now because it's bullish. He wants everyone to short the stock first so that he can make a fool of everyone. This is the story you have to tell with Tesla. He's a very unique CEO. A lot of Tesla's value is tied to him personally. Yes, tell that story. I remember one of your videos a few weeks ago, you mentioned nobody believes in Musk anymore, and you specifically mentioned the stock doesn't rally anymore because of things he says. Stock didn't rally because of things he said. The stock rallied because of a $2,600 price target, and then him saying it should be 30 trillion, which is just a ridiculous statement, which then primarily caused a short squeeze, which then brought the momentum traders in that started buying calls. It wasn't anything he said. It wasn't anything he said. Here we are. It's up 40% in 1 week. Now, let's play the other game. Let's say that's because of something he said. Does that sound like a reasonable reaction to you? To be up 40% in 1 week from an already overvalued position? Does that sound like a rational market reaction to you? Come on. I don't think so. Personal opinion. Tesla's value has always been high because it's speculative based on the future and will always be that way. And that's what you have to keep saying, is you have to keep saying it's all in the future, because the future can't be, you cannot disprove the future because it hasn't happened yet. So almost anything is possible in the future. Almost anything is possible, and you have to keep saying that. But yeah, that's the story. And if we can continue to tell the shareholder that story, they'll continue to buy calls. If they continue to buy calls, the market maker will continue to buy stocks, and up it goes. That's the trade. It has nothing to do with the value of the company any longer. That got left behind $50, $60, $70, $80 ago. That got left behind. This is really about who can tell the biggest story, who can hype this the most at this point. But just to put something out there, Tesla lost money all the way to the second quarter of 2020. Had the pandemic never happened, it would be questionable whether Tesla would be profitable today. What made them profitable was they could suddenly start selling every car they could make at full margin and even more margin. That's what made them profitable, till everyone recognized that there were nice margins over there, and regulations started pushing auto companies to compete. And once they started really competing with Tesla, look what happened to their growth. 2 quarters in a row now, negative growth, first time in their history. Musk has never had to compete with other car companies in his space. Never had to compete. Now he does. I don't know that he's a unique CEO. I think he's a unique visionary, but there's a big difference between being a visionary and being a CEO, because what he did over the last year would be cause for firing on the spot. Any other CEO would have lost their job hands down. He's got his job because he, as you say, he's the face of Tesla. But he is not, I think, a unique CEO of our modern day. I don't see that he runs a company well. I don't think he thinks that way. I think he's got a unique vision of the future and a stubbornness and willingness to keep pushing towards that future. But he's never had to compete until now. Now that he has to compete, in the last few years he's had to compete, market share has dwindled. His growth rate is now negative. His margins are car company margins. They're car company margins, like I said they would be. He doesn't get to keep those. And it's going to continue to get worse. We're going to see exactly how strong of a company he built when he's faced with competitors with 100-year histories. And then we will see. Okay, that's it.